RBC says home sales are down, prices are down. This is not news to us. You've been following along. We're here with our good friend and mortgage broker, Mr. Dion Beg. He shares with us how, if you're on a pension, you can get approvals still today. If you're self-employed, you can get approvals still today. All this and more with Dion Beg right after this. Here we are, my friends, back with our favorite mortgage broker in all of the land, Mr. Dion Beg. How you doing, my man?
I'm good, man. I'm just freshly back from the land down under. I went to Australia over the summer.
I can tell a little kangaroo behind you there.
Oh, yes. Got the new mascot. Which side is it here? That is actually technically a wallaby, but we're going to adopt him into the kangaroo mortgage family.
Yeah, it makes sense. It makes sense. I like it. So, you know, we kind of take maybe a month off. You know, it's summertime, everyone's kind of kicking back. But man, this Canadian real estate market or Canadian economy is just, it's something special, isn't it?
Well, every day there's a story. Some of them we don't want to hear, but yeah, there's a lot going on right now.
Yeah, no kidding. So what are we going to touch on today? We got a few real life, real action stories and examples that Dion's going to share with us. You know, everything from using and leveraging your pension to, hey, you're self-employed and how do we get someone like that financed? But before we get into things like that, Dion, we should probably touch on, RBC and the housing special housing report. Why do we bring this up is because RBC provides a yearly housing report that a lot of the industry will read, and they do a great job of providing us, you know, where we came from and where we're going to go. And every now and then, just like every economist and everyone else out there in their basement that pretends to be economists has to reevaluate and reproject and look at the numbers. And of course, this year has been no different with things happening south of the border from us, Dion, and that impact. They've had to re-release. They had to release a special housing report. I'm just going to share my screen, and we're only going to highlight just some of the things here, and I'll put the link to this article in the show notes that you can go and read yourself. But this just came out a couple of days ago, and some of the things, Dion, that we're going to highlight here is this first graph here. I know it might be small on screen, but I just want to highlight what we're talking about here. I've often talked about in the Canadian real estate market, or especially in the GTA, if we have about 90,000 sales in the Greater Toronto area, that's a good moving market. Dion, bigger than that, right across Canada, approximately 500,000 sales every year is good. It's just good for the economy. It's not outlandish and crazy, and it's not so low that, you know, nothing's happening. It's just good for the market. So approximately 500,000 sales, and in fact, you can see that's where the that yellow line kind of hovers around. And RBC earlier in the year suggested we're going to surpass that this year. We're not going to surpass that.
Okay. So we're going to be just under the 500K sort of comfortable number?
Yeah, just under that comfortable number. In fact, their actual line here is we'll decline about 3.5% to 467,000 projected resale homes. And in fact, Canada, BC and Ontario will see numbers slightly less than that. And of course, how those two provinces go typically is how the rest of Canada goes. And you can see their forecast numbers here into next year, 2026, by the quarter, will remain below that number. So we'll have to keep an eye on that. And I'm sure if you've been in the market, this is no news to you, right?
Yeah, and I think if I was RBC, that the huge thing that's changed in the bigger economic landscape is the federal government's view on immigration, right? This time last year, we're looking at, continued open door immigration. And now we've basically turned that tap off saying, no, we're not actually taking on any new permanent residents or very marginal. And so if I'm RBC, that's probably one of the biggest factors that I'm looking at here, the fact that we're not having growth in immigration. In fact, we're probably going backwards.
Yeah, fair point. Exactly. And we're just highlighted a couple other things in here. Home prices, they're saying, is going to come down, nationally down about Now you have to read this number, 0.7%. So we're not drastically. And if you look here, I was sharing with Dion earlier, our kind of home price in the second quarter, the benchmark price was, call it 825. Well, there it's come down to 808, 809,000, and kind of around that 815. That's the benchmark price nationally right across Canada. And I don't know about you, Dion, but I've never bought Canadian real estate. How about you?
Well, yeah, I mean, look, there are ups and downs. And in terms of, long term, we all see the hockey stick that we always see on these 50-year graphs. What's this? This is like a 3-year projection. Look, I'm not concerned, but, are we going to expect to see the standard 10% growth that we saw in the GTA over the last 15 years? No, that's not happening. And again, it's a function of that, the demand, right? So which in many past years has come from population growth, which is not going to happen in the next couple of years.
That's right. And both Deanna and I, we buy specifically in our favorite neighborhoods. That's the area. As an example, we buy real estate in Oshawa, in that Durham area, in Pickering, in Stouffville. That's the market that you need to be keeping an eye on, not the Canadian national real estate market. Is the very specific market here. And of course, I just want to scroll down, in fact, to just so everyone has an idea. We won't spend a lot of time here, but that unemployment rate. We know the unemployment numbers just came out, and it was higher than what a lot of people wanted and expected and things like that. Yet, we might see that, and they're suggesting that that's going to come down over ever so slightly to about that, just above that 6%, 6.3% by 2027. So in a year from now, we should be about that, almost hovering around that 6% there, which is a good thing.
Yeah, I'm going to sound like a broken record, but again, it's because immigration again has effectively stopped, so that the jobs that are out there will generally be absorbed. We would hope, right? This last quarter, this last report was a loss of 40,000 jobs nationally, which was a big shock for people. And as that relates to interest rates, Gary, I might be jumping ahead. You would think that would lead to a automatic drop at the Bank of Canada meeting next month. But the Bank of Canada is balancing job losses together with the potential of increase in inflation due to tariffs, right? So the Bank of Canada is in a sticky situation where without this looming potential tariff situation, yes, I would say it's a straight line to reduction in interest rates. But yes, everything's up in the air at the moment.
Yeah, it is. And you can see kind of what they're suggesting here with the interest rates are lower, but no longer declining in Canada is their big headline, if you will, for this part. But that's always a moving stat, if you will, right? It really fluctuates, and they have to make their decisions based on the news at the current time, not forecasting out like this, right?
Yeah, and I think it's just uncertainty to how the U.S. administration is going to treat Canada as it relates to tariffs and vehicles and all this other stuff that's been going on. Uncertainty is worse than knowing bad news, right? At least once you know that there is bad news, then you can strategize and plan for it. But the uncertainty means that you have to plan for the absolute worst case scenario. And I can understand why, these interest rate projections are not super positive for the consumer. But yes, you're right, they could change as things get clearer with our southern neighbor.
Yeah, that's a great point. I like that point. Affordability issues will persist despite easing, and of course, with more opportunities, more homes on the market, more listings, and that drives prices down ever so slightly as well. So affordability is coming back a little bit, but nothing like we've saw 15, 20 years ago. That I think I don't know if we'll ever see affordability like that in the near future, based on what's going on in the worldwide economy.
I think that ship has sailed. And again, anecdotally, coming back from Australia, there is almost the identical situation. Similar government policies have led to similar affordability issues, and the solutions aren't really clear, other than production of effectively affordable housing, which is government housing, not that is rental housing, and trying to pump that out as much as possible. But it doesn't really help the buyer if there's not much of a push for production of resale homes available to the general public, right? And that's the challenge that we're seeing here.
Yeah, that's it. So that's the special housing report. Go check it out yourselves and do some of your own due diligence, of course. I'm always the glasses half full type of guy. If there's, obviously there's lots of opportunity in that market, in the real estate market, and then in pretty much everywhere you go, you'll see lots of listings, especially in the condo areas, in the Toronto and Vancouver area. I guess if there's one saving grace at all, if you are a seller, you're also a buyer. You do get to sell and buy in the same market. And one nice thing here in the Canada versus U.S. mortgage land, if you will, we get to port mortgages. So if you have a low rate, hopefully you can port that into a new mortgage and have a blended rate. Where in the States, if you sell your home, you have to go get a brand new mortgage. So that's why we're not seeing a lot of home sales in the States, because they're on a fixed.
You want to hold on.
Yeah, exactly. Where in Canada we do it differently. Okay. Let's get into some of the people you've been supporting and helping for the last month or so. And I like this one. Not often do we realize our pensions can support our financing and our housing from what's the word I'm looking for? Not affordability. Getting approval. Approval is the word I'm after. Yeah. So talk to us how we can use that and get approvals from different sources.
Yeah, sure. So I'm about to send this email to my database, and the subject line is going to say, "Mum's measly $22,000 pension helps buy $1 million house." And you might say, well, how in the world is that possible? Well, first thing, let me say, what we're dealing with is a younger couple. And when we ran their numbers, it looks like they by themselves could qualify for the low 900s. But the reality is that the properties in the area they want to buy are priced at closer to $1 million. And they know this. And when we explore all these options, we always ask the question, look, do we have the potential for extra income, usually in the form of a cosigner? And the gentleman in the application said, yeah, well, my mum's a pensioner, but she can't help us. And I said, well, why do you think she can't? So, well, she's a pensioner. She's only getting pension income. And what a lot of people think is that if you're on pension, we can't use that income to qualify. So first thing I want everybody to know is pension income is 100% usable by Canadian lenders on mortgage applications, in the same way that, let's say you're a teacher earning $100,000 a year. If you're a pensioner earning $20,000 a year through your CPP and OAS, we can use that in the same way. Okay. The next thing is, like they say to me, well, it's such a small amount. It's like $20,000 a year. How does that help us? And depending on the parents' other debt load, that might boost our borrowing power by $80,000 plus. And so that extra $80,000 for this particular couple was had a material impact on the type of property that they can actually purchase. So yes, pension income can be used, and yes, mum's $20,000 in pension income helps buy that $1 million home for these buyers.
There you have it. I like it because you just never know, and I love that's what you do with your clients is you just keep asking questions. And it's important to keep asking questions, right?
Yeah, I can't tell you the number of times people come to us after having explored this with, say, their bank, and they say, oh, they never asked us this question, or they never told us we could pay off the car, which would allow us an extra $200,000 in borrowing power. So yeah, it's just being in this business all day, every day. Whenever somebody comes to us, I always look at it like a puzzle, and everybody's unique, but there are patterns in the puzzle that we can, draw on from the thousands of other people we've spoken to over the years. And so we can generally identify those opportunities pretty quickly.
Excellent. Okay. Speaking of pensions, which is fixed income, oftentimes when we're, later in life, we're on a fixed income and everything around us, all the pricing and everything and the cost of living has gone up. And you shared a unique story with me where one of your clients had his property taxes just kept adding up and adding up, and when you're on a fixed income, it's tough to keep up with that. How were you able to solve that? I love this story.
Yeah. So this gentleman, he's around 80 years old, and he got himself into a situation where he was about $50,000 behind on his municipal property tax. And there'd just been some life events that had happened which had not allowed him to keep up on that payment. And as you know, Gary, there reaches a point where, the municipality is usually forgiving to an extent, but there'll come a time when things start to accumulate where they might end up putting a lien on the property. And so we're going to be able to avoid this issue. Again, the gentleman's on a fixed income. He won't qualify for a standard mortgage in his case, and he doesn't have any co-signers or any other income. But what we're doing here is getting a reverse mortgage, which will not only have him be able to pay that out, but also put a couple of $100,000 in his hands with which he can enjoy the next couple of decades of his life. And without that pressure of concern of not keeping up with property taxes.
I like it. And my friends, if you're curious what reverse mortgage is, or all you've heard is the nightmares from 25 years ago or more, Dan and I did a webinar, which over an hour long. I'll link that, and you can go educate yourselves on that if you know of somebody that could benefit. That it's a great webinar. And I was educated during that webinar. So Dion, thanks for putting that together. Okay. Obviously, over the last 12 months, and specifically over the last number of months, our mortgage rules are changing and will always ever change. And when change happens, that provides some opportunity, and hopefully that opportunity is also in savings. Talk to us about how the mortgage changes can help with the savings on your monthly payments.
Yeah, so I was meeting with a young couple in the last week, and I'd actually met with this couple 2 years ago. And at the time, they were looking to purchase a $750,000 property with a minimum $50,000 down payment. And back then, that monthly payment was going to run them around $4,900. Okay, and it was high because of two things. One, interest rates back then were 6.5%, and secondly, the maximum amortization was 25 years. If we fast forward to today, that with a lower interest rate at 4.5% and amortization now at 30 years under the new guidelines, that payment's dropping from around $4,900 down to $3,700. Okay, so they're basically saving $1,200 a month. And 2 years ago, understandably, they weren't ready to commit to that much higher payment. But now, with a much lower payment, it's $14,000 a year in savings here. They're ready to move forward. So if anybody's listening and they visited purchasing a couple of years ago and they think it was just too hard, maybe it's time to just check in on it again. Also, and this is part of the conversation with them, is like, they're buying in markets now where there's so much more choice, right? Yeah. And so they may not actually have to pay the $750 that they were going to pay 2 years ago because there's a little bit more competition from the sellers as buyers are in a more powerful position.
Yeah, excellent. Okay, we all know that we have a lot of people watching because they're self-employed. Or perhaps they're a realtor like me, or a mortgage broker, even like you, or they're a contractor, restaurant owner. Talk to us about how this restaurant owner was able to use, their income when banks don't like that unverifiable income and all that kind of stuff. How were you able to get him or them approved?
Yeah, so the situation here is we've got an individual who makes good money, but not much of it makes it onto the tax return. This happens for a lot of self-employed people. And we're in $1 million home. In this case, he actually doesn't have any debt. And he needs to buy this $1.5 million property because his adult children are going to continue to live with him and they just need more space. So he had been to a bank and another advisor who had basically said there's no way we can help you because of the income situation. But when we look at this, at the whole scenario, we were able to take that deal to lenders who don't really focus on income, but focus on the equity position in the property. And long story short, we needed a $1.5 million mortgage, and we are basically getting a small mortgage on the first property, using that as down payment on the next, and then once that property, and then they're going to move into the new property. they're going to then get a mortgage on the new property as well. Once they sell the old property, though, we're going to take some proceeds of that sale and pay down this mortgage. And so temporarily, this gentleman's going to go into a debt of 1.5 million, but then long term, he's going to only hold a 500K mortgage. And this is all doable through equity lending, which doesn't require income verification. And you can also do this under open or closed products, which allow you to pay things off. And so the concern for this gentleman was like, am I going to be able to pay this off the minute I sell my old home? And the answer is yes, if you get the right product. So yeah. And by the way, this came to me through a real estate agent who had been in the business now more than 20 years and was feeling stuck. So if you're feeling stuck as a consumer, just know that even professionals in our industry are not aware of all the products that are available on the mortgage side. And if you're feeling stuck, again, feel free to reach out because maybe we've seen your problem before.
Yeah, I love it, and that's just the knowledge of who you're working with and making sure you're working with the right people and keep asking those questions. There's like you said, you've experienced this before. Dion, talk to us. You touched on it, and I just want to make sure you provide a little bit of clarity on it. You said making sure you can pay it off versus open and closed. Sure. Mortgages, and I know I just don't want that to be a little tidbit. I want to make sure we have understanding on that.
Okay, so when you take a mortgage, it can be most mortgages are closed mortgages. So if you've got a mortgage, say at a major bank, 5-year mortgage, it's going to be a closed mortgage. What that means is, in order for you to exit that mortgage, in most cases you can exit, but there will always be a penalty, a prepayment penalty. So that's a closed mortgage. A fully open mortgage allows you to exit the mortgage at any time with zero exit penalty. Okay. And so a lot of people think that variable rate mortgages are open mortgages. That's a common misconception. That is not true. Most variable rate mortgages are closed mortgages. It's just that that penalty is smaller than what you would generally get on a fixed penalty. And that penalty is 3 months interest. So if let's say I'm working with a client who is a contractor who flips property, he definitely doesn't want a 5-year mortgage, closed mortgage. He wants an open mortgage, which will allow him to sell the property at the time of completion of renovations and whatever, without any penalties. So these are important questions to ask if you think that you're not going to be in the property for a long period of time.
Excellent. We can go deep on what that means and why you would have open versus closed, but the property flipper is a good example, and the interest rates we can talk about that on another video on how they're slightly different as well. Dion, how do people get a hold of you?
Yeah, you can reach us at kangamortgage.ca or Instagram at @DionBeg.
There you have it. That's Dion Beg. I'm Gary McGowan. We'll see everybody in the next video. Goodbye for now.